Hi, my name is Michael King. We're going to come back and look at a second way to value an equity, a common share, using a dividend discount model. But we're going to use a two-stage dividend discount model. This is section 7.3 in Booth, Cleary, and Rokita. Okay, remember when we were looking at Royal Bank of Canada's historical dividends, we saw that growth was very high in the periods from 2000 to 2008. And then it was much lower and seemed to be declining over time as the dividend was getting higher and higher. This kind of pattern of very high growth followed by lower growth is typical for companies as they grow and mature. So we cannot use a simple dividend discount model to value the stock because we need to have a constant growth to be able to forecast the price. The solution is to break this problem into two parts in what is called a two-stage dividend discount model. Okay, so let's look at this example. If the growth rate is greater than the discount rate, that means the model can't be solved because we're dividing by a negative number. And if the growth rate's not constant, we can't use the model either. So what we're going to do is we're going to break this down into several steps. First, we're going to forecast the expected or anticipated dividends during an initial period of several years until the dividends start to grow at a constant rate as the firm matures. At that point, we're going to be able to use the constant growth dividend discount model to value all the future dividends in the future. So having forecast the dividends in the early years and then the constant growth dividend discount model some point in the future, we're simply going to discount those two sets of cash flows to find the price today. Let's take a look. So here you have it. You have dividends 1, 2, and 3, which are potentially growing at a very high rate. And then from dividend 4 onwards, they grow at a constant rate. Now notice that we're going to be growing dividend 3 by one period and then two periods as we go forward. So what we can do is we can simply simplify and calculate what the price of the stock would be at the end of the third year by using our standard dividend discount model. So in year 3, the price of a stock is going to be the dividend in year 3 grown by one period divided by K minus G. Put differently, we can use the dividend in period 4 and divide it by the difference between the expected return on equity and the growth rate. That will give us the price in year 3. And then we simply put that into our magic formula. We have the three dividends, dividend 1, dividend 2, dividend 3. We discount them, and we discount the price that we expect to receive at the end of year 3. Notice that this starts to look like valuing a bond, where we have a series of cash flows, an annuity, could be a constant annuity, but it could be also a growing annuity. And then we have some sort of face value or terminal value that we're going to receive at the end. Here's an example. Here we have a company where they have dividends at the end of the coming year of $2, followed by dividends of $3 and $4 at the end of years 2 and 3. From after year 3, dividends are expected to grow at a constant rate of 4% per year. What is the price of the stock if the discount rate is 11%? Okay, so what I've done here is I've set out all the periods, I put down the growth rates, and I've forecast the dividends. You see dividend of $2 in year 1, $3 in year 2, and $4 in year 3. And at that point, they start to grow at 4% per annum. So you see that the dividend in year 4 is simply $4 times the growth rate, 1 plus the growth rate, or $4.16. Okay. So what we're going to do is we're basically going to take all the dividends from year 4 onwards, and we're going to figure out what they're worth at the end of year 3 using that constant growth dividend discount model. So we take the dividend of $4.16, which is the dividend in year 4, and we divide it by the difference between the cost of equity of 11% and the growth rate of 4%, and we find that at the end of year 3, the stock is worth $59.43. That is not the price today. That is the price 3 years in the future. So now we have to discount the cash flows that we will receive, the $2, $3, and $4 dividends plus the $59, and we have to discount them by 1, 2, and 3 years. Finding the present value and adding it up, we see that the price today is $50.62. Let's take a look at another example. You have a common stock that paid a $1 dividend over the last 12 months. The dividend is expected to grow by 10% for the first 5 years, and then 2% in perpetuity. What is the price today if the cost of equity is 8%? Notice that in this problem, you're given the most recent or the current dividend and not the future dividend. When you set up your table, you're going to have to forecast what the dividend will be in year one. It's going to be $1 grown at 10% or $1.10. Notice that we're going to grow that dividend by 10% for the first 5 years. In the fifth year, it's going to be $1.61. Notice that the dividend then grows at 2% from year 6 onwards, which means that we can value the stock at the end of year 5 using the constant growth dividend discount model, which is simply going to be $1.64, which is the dividend in year 6, divided by the difference between the discount rate of 8% and the growth rate of 2%. Figuring out those cash flows, we have the 5 dividends plus the future value at the end of year 5. We find the present value of those cash flows at 8%, and we add them up to get the share price of $23.92. Notice that critically, we do not include the last dividend of $1 in this calculation. We needed it to calculate what the dividend would be in the future, but you do not receive it if you buy the stock today. That dividend was received by the prior holder. Let's look at RBC and see if we can value it using a 2-stage dividend discount model instead of a 1-stage. Okay, so we know that the expected dividend in the next period is $4.35 per share. We figured out the sustainable growth rate is going to be 6.4%, and let's assume that that remains constant for 4 years, but then drops down to 5% thereafter. What is the implied share price if we have a discount rate of 10%? Okay, notice that our dividends are going to grow from $4.35 in year 2021 to $4.63. It's going to grow at 6.4% for the first 5 years. And then it's going to grow at 5% thereafter. So at the end of year 5, we're going to calculate what the price of all those future dividends will be using our dividend discount model with constant growth. Notice that it's going to be $5.86 divided by the difference between 10% and 5%, the growth rate, or $117.12. Discounting all those cash flows, the dividends in the first 5 years, the price at the end of year 5 to today, we find out that the stock should be worth $91.25. Notice that this price is less attractive than what we found before. Why is that? Well, the price is lower because the dividends are going to be lower in the future. In other words, because they're not going to grow by 6.4% in perpetuity, but they're going to grow by 5% starting in year 6, that will reduce the share price considerably when we take the present value of those lower cash flows. This chapter by Booth, Cleary, and Rokita also looks at something called the present value of growth opportunities. We can use a few of our assumptions to determine what the present value of growth opportunities will be for a stock. What we're going to do is we're going to break up the value of stock into 2 parts. The value of a stock as if there was no growth and all the earnings were paid out, and we're going to add on the present value of growth opportunities. Okay, so let's assume that all earnings are paid out as dividends, or in other words, the dividend per share is equal to the earnings per share, and the payout ratio is 100%. If we plug that into our sustainable growth formula, you can see that it turns out to be ROE times 1 minus the payout. 1 minus the payout is 0, so the growth rate is going to be 0. As we said, no growth. If we use this to value the company, then the value of the company simply becomes the present value of all the dividends. And because we're paying out all earnings as dividends, it's simply the earnings per share divided by the discount rate. We can then look at this as the value of the stock with no growth. And if we look at the actual price of the stock, then the missing component is the present value of all the growth opportunities. Let's take a look at an example. Okay, coming back to RBC. RBC's share price on this date was $105.81. Its earnings per share in the last period was $7.82. We saw the sustainable growth rate was 6.4%. Growing earnings from last year to get the expected earnings per share in 1 year in the future, we see that $7.82 is going to grow to be worth $8.32 per share. We use a discount rate of 10%. If we simply take that EPS of $8.32 divided by 10%, we get that the value of with no growth is $83.21. And if you deduct that from the share price of $105.81, we see that the present value of the growth opportunities must be $22.60. One last topic is, what is the relationship between the dividend discount model and the PE ratio? Is there a relationship? Notice that we have the constant growth dividend discount model with the dividend in the next period divided by K minus G. Well, that dividend is actually a payout of earnings, so we can express it as earnings per share times the payout ratio. And the payout ratio itself is actually dividends per share over earnings per share. Now, if we're to divide both sides by earnings per share in the next year, you see that we get the PE ratio on the left, price over earnings per share in year 1. And on the right-hand side, we have the dividend payout ratio divided by K minus G. This is another way to think about the PE multiple and what it implies. Notice that if the dividend payout is higher, that will increase the PE ratio. Notice that if the growth rate is higher, that will also increase the PE ratio because it's going to make the bottom of part of the ratio, the denominator, smaller. Notice that if we discount at a higher rate or a higher discount rate, it's going to make the PE ratio lower. So let's look at an application using RBC. Okay, so RBC's dividend payout ratio is 55%. We saw a discount rate of 10%. Sustainable growth is 6.4. What is the implied P ratio in the next 12 months based on these inputs? Okay, so it's the dividend payout ratio divided by K minus G, or 0.55 divided by the difference between 10% and 6.4%. We find that the implied P ratio is 15.3. Now we can use that if we know the forward earnings to figure out what the implied price should be in a year forward. So if the earnings per share is expected to be $8.32, all we do is we multiply 15.3, the PE ratio, times earnings per share of 8.32, and we get that the implied share price next period is $127.16, which is considerably higher than the current share price of $105.81. Is it accurate? We will know in 1 year's time. The problem with all these models is that they're forecasts and they're based on assumptions, and these assumptions are relatively simple. So just be aware of all the limitations when using these, either the dividend discount model or the PE multiple to value a stock.